Fox 10's John Hook.
Thanks to the bold and decisive action we've taken since January, I can stand here with confidence and say that we have pulled this economy back from the brink.
And that was the president on Wednesday night. Now, that may be true and it may be fine and good, but a lot of people are not pulled back from the brink. Even if the economy is back from the precipice, a lot of people are still feeling the pain. And we're going to try to help you navigate these waters with a guy who knows a lot about it. He's the author of Financial Intelligence, Getting Back to Basics After an Economic Meltdown. Jacob Gould, he is a certified financial planner, and he's appeared on CNBC, Forbes, Kiplinger's. He's been in the Chicago Tribune, Wall Street Journal. He's now a noted author. Book's been out a month, right?
That's correct.
And you really walk people through some of the biggest mistakes they make, and you guide them on what they should be doing.
Absolutely.
And you run through the history of '08. And when I was reading the calendar on the stuff that happened last year, it is remarkable we're all still standing, frankly.
It was a momentous year for sure.
And so how is this different now than just people normally trying to manage their money, plan for retirement, get their kids through school, whatever it may be?
Well, I once heard that when your neighbor loses his job, it's a recession. When you lose your job, it's a depression. And there's not a single person out there that hasn't been negatively affected by this economic meltdown. And although we are starting to see improvements, we are a long ways away from being out of the woods, and there's still going to be a lot of unpleasant surprises. So with that, people really need to step back and maybe for the first time in their life, assess what they want from themselves financially. And they need to go back to the basics and really chart their financial future, perhaps for the first time.
Okay, so for the, let's just take it a typical, let's just say, let's start with a family of four with a median income.
Yeah.
What should they be doing?
The first thing that they need to get their arms around is their cash flow. They need to know what type of income is coming into the household, what are their fixed costs, their mortgages, their car payment, their utilities, what are their variable expenses, their cable television, their cell phone, going out to eat, and they need to manage that. Everybody needs to be on a budget. You need to manage where that money is going, and that's the most important thing. And once you have that, it's all about managing debt. I'm very anti-debt, so if someone can afford to get themselves out of credit card debt, I think financially speaking, they're going to be much stronger than they've ever been before.
You probably saw this, and the Valley got caught up in it, no question about it, where people were getting pushed by mortgage lenders. They were pushing themselves to get into a bigger and bigger home because it seemed like get into as big of a home as you can get into that you can afford because the bank's holding most of the note on it,
right?
And you potentially could make a huge amount of money, and people got into serious trouble over this.
Absolutely, and unfortunately, greed took us to levels that we should have never gotten to, and we're paying the price for it today. Our home prices are still declining as we speak, and it will take time for things to settle down. But nonetheless, people were using their home as their personal ATM machine, and they were expecting their home to go up by 10, 15, 20%. And what people have to realize is that credit is not a right, it's a privilege. And we need to respect it and we need to manage it. And for the first time, people are realizing that it's not easy to make a buck. And they need to be prudent. And if anything, less is more these days.
Okay, so let's take our family of four, median income, along with a new worker into the environment. Somebody who's maybe 24, 25. What is a single thing that they should be doing?
One, if their company offers a match, let's say it's a dollar-for-dollar match up
on
to
a 401k.
On a 401k. So let's say it's a dollar-for-dollar match up to 3% of pay. I would encourage them to put at least 3% of pay inside their 401k.
It's before taxes, so you're not going to miss it.
Correct.
It's not as if you're going to lose 3% of your pay.
That's correct.
After taxes, it's really like a 1.5%.
Yeah, depending on your tax rate, absolutely.
Right.
Yeah.
So get into that.
Get into that
and
first
early.
and foremost. Earlier the better. Anything over that, if you have credit card debt, I would encourage people to pay off the credit card debt. But if they're not in credit card debt, we'd encourage them to put as much into the 401k as they possibly can. That money will be growing tax deferred for them throughout their career and hopefully provide some type of stable income for them.
You put an illustration in there. If you were to put in the minimum, which I think the federal government's 16 grand a year that you could put into a 401k.
Right.
how much that accumulates and not accumulates, what's the word?
Compounds.
Compounds over their lifetime.
Yeah.
Give the example.
Yeah. The maximum amount that you can contribute to a 401k in 2009 is $16,500, and that doesn't take into account any match. If someone were to put away the max, or even just 10-15% of their pay, and they did this for 20 plus years, they should have plenty of money, as long as they're well diversified, to have a good income into retirement.
One of the illustrations was if you did it early on in your early 20s, this would be worth $4 million by the time you retire.
Time can either work for you or against you. And the earlier someone can start, the more their nest egg will grow to. And so even if it's $50 a month into their 401k in their early 20s, that will amount to so much more than they could ever imagine.
What's the common mistake people make aside from the 401k, not getting involved in that?
You know, the most common mistake would be that they get too emotionally attached to their decision making. They don't have the basic financial education to make an informed decision, and perhaps they are easily persuaded by perhaps a television show or a newspaper, and they get scared and they react to that emotion, and this last year they went all cash. So now they're completely out of the market.
And they missed a very nice run up.
Since March, the markets are up over 50%. And so if an individual went in from the very beginning and came up with a well-diversified program of stocks, bonds, and cash, they wouldn't have had the same volatility as the market. So perhaps they would have had enough patience to get through that difficult period of 2008. And today they would be much stronger than if they would have placed a panic trade and go into all cash.
As a certified financial planner, when people come to you, is it because they're in trouble or because they are trying to plan ahead?
For us, and I think every shop is different, for us, when people come to us, most of the time they've already accumulated wealth and they need to take it to that next level. They've done everything that they possibly could do inside their 401ks, their IRAs. This financial market is so complex and confusing, they need some additional guidance, and that's when people come to us.
Is it safe to say that in investing there is no quick hit? There is no, people have talked about, well, I'm going to get into gold and I'm going to make a run on gold, and
right.
Gold's up around $1,000 now.
Yeah.
Too late to get into something like that, but again, it's diversity.
Yeah.
Right?
In my opinion, if you were to use the parable of the tortoise and the hare, our strategy would be always that of the tortoise. Slow and steady. You're never going to make millions overnight. There is no way to properly time the markets. You need to be diversified, you need to be patient, and you need to be focused long term. That, in our opinion, is the best way to create wealth.
What about for people who don't have money at the end of the month? They just don't have any money to invest. You're saying at least get rid of the credit card debt, at the very least.
And in that scenario too, that's why budgeting is so important. For them to track their expenses. And they can do a little bit without. Maybe it's downgrading their cable. Maybe it's downgrading their telephone. Maybe they start carpooling with individuals. If you understand where your money is going, you can be the judge of where that money should be going in the future. And they may be surprised to be able to find a couple of $100s a month to put into a 401k account or to pay down their credit card debt. But people need to be active in their personal financial situation.
And it's interesting, it's never been easier, frankly, because of online banking. You can almost run a spreadsheet off your online banking and see where the money's going. You can run it for 60, 90, 120 days and see, okay, where is the money going?
Absolutely.
As long as you're not paying cash for everything, then you may not know.
And that's one thing that I mentioned in the book, is to try to avoid the ATM machines, because too many times people get in the habit of going to the ATM machine every week, and maybe over a month time they've taken out $200-300 from their ATM machine. One, maybe they're paying fees because they're not going to their own bank's ATM machine, which is an issue. But two, once you have that cash, it's very difficult to track where that money goes.
After 401k, you talk about neglecting to prepare retirement income and expense projections during your working years.
Yeah.
You've only got a limited, you got to make hay when the sun shines, right?
Absolutely. Well, and retirement for us today is much different than retirement was for our parents and our grandparents. When our parents and grandparents passed or retired, they maybe had 5-10 years before they passed away. Whereas when you and I retire, we very well could have 30 plus years in retirement. So we have to have a lot more put aside for us. And we don't have pensions like we used to have. And as we know, Social Security isn't exactly on solid foundation. So we need to take a more active role in our own personal finances.
But you do believe the politicians will figure out a way. They will not let Social Security dissolve.
I think in some shape or form they will, but we all will pay the price for that.
Possibly